All right. Hello and welcome, everyone. Why don't we go ahead and get started? Welcome, everyone. Thanks for tuning in here today. We're going to get these videos restarted here over the coming weeks, which I'm very excited about. And wanted to kick off today with the question that came in from somebody. We'll call her Lynn. And it really has to do with several, kind of thinking through the ways that we can start to save for retirement. And in particular, Lynn had a few different questions. First and foremost, just kind of reading what she sent in, knowing that a 401k won't be enough for us to get to retirement to the point where we could live purely off of that. What's the next best place for us to put our retirement money? And then kind of part two of that question was, whether or not it makes sense to use a Roth IRA or a retirement account versus a traditional pre-tax account. What's the right strategy to choose? And then finally, how much do you actually really need to save in order to retire? There's so many so many different options out there in terms of the things you read. You need to have X amount of dollars saved up by the time you reach 30, 35, 40, and so on, right? How much do you actually really need to save for retirement? So I wanted to take a little bit and talk through all of those questions kind of together, if you will. And the way I want to think about this is the different tiers of retirement saving that are out there for you, right? How should you be prioritizing how to save for retirement, right? What's the order you should kind of think through these things in? And so first and foremost, as Lynn alluded to in the question here, the very first thing we want to do when it comes to saving for retirement is to take advantage of your retirement account at work, if you have one, right? Most commonly, these are 401k accounts if you work in a nonprofit role, either in a hospital or in a school or in another type of nonprofit. You'll have 403b accounts. Government employees have 457 accounts, right? There's different ways these can be set up, but they fundamentally work the same way, right? And first and foremost, right, when you're thinking through how you should be saving for retirement, that's where you want to start. Now, most of these accounts are pre-tax. Sometimes, it's become increasingly popular over the past few years or so that employers are offering Roth accounts as a way to save for retirement. We'll come back to deciding between pre-tax or traditional accounts versus a Roth account in a little bit. But first and foremost, right, before we get to outside accounts, you want to be saving for retirement at, through your 401k or similar plan at work. The most you can contribute to that is $18,500 a year. In 2018, that's going up to $19,000 a year in 2019, right? You can contribute a lot of money to those accounts. It's relatively hard to max those out, particularly in the early stages of your career. So that's where you want to be started. At a minimum, you want to contribute to those accounts up to the point where your employer matches, if you have an employer match through your retirement account. But beyond that, right, certainly I encourage you to contribute more if you can swing it. The best practice that I've come across to find ways to increase the amount you're putting into your 401k account, pretty simple actually. Every time you get a raise, increase the amount you're contributing to that account by 1% each year. A lot of employers offer annual raises and things like that. Increase your retirement account contributions 1% every time that happens. You'd be surprised at how quickly the amount of money you have in there really does add up if you do that. Case in point, I started my career at PricewaterhouseCoopers, the accounting firm. Worked there for several years before I shifted into the personal financial advising space. By the time I left that job, I was contributing 12% of my salary to my 401k. Right? Now, did I start there? Absolutely not. I did not. I started relatively high up. I think I started at 7 or 8%, which was great. But every time I got a raise, increased at 1%. By the time I'm 30, I'm well over 1/3 of the way done saving for retirement, just from slowly and steadily increasing those contributions every year. So long story short, you want to start with your retirement accounts at work. From there, as Lynn alluded to in this question, 401k accounts alone likely aren't going to be enough for you to live off of in retirement. So what's the next option you should think about choosing? And my second choice for saving for retirement might actually surprise you, in that it's not actually a retirement account at all. If your health insurance is set up so that you're eligible to contribute to a health savings account or an HSA, that should be your number two option in terms of saving for retirement. When we talk about these distinctions between traditional and Roth accounts when it comes to retirement, the question really is, when are you going to be taxed on the money that you're saving for retirement? Are you going to be taxed now, or are you going to be taxed later in retirement? And the reason why I prefer HSAs to those types of accounts is because there's actually not a choice when it comes to HSAs. HSAs are never taxed. The money you put in is contributed before you pay taxes from your paycheck. As long as you withdraw the money to use on medical expenses someday, the money you take out is tax-free as well. HSAs are, by and large, the only tax shelter that is A, effective, and B, left in America. Relatively low contribution limits, but if you do have an HSA, and particularly if they let you invest in that account, which most do these days, that should be your next step when it comes to saving for retirement. HSAs are not retirement accounts, right? But medical expenses and paying for end-of-life care, things like that, are part of the equation for saving for retirement. So if you're in relatively good health, not spending a lot of money on healthcare right now, putting your savings into an HSA can be a very effective way to save for retirement. And I see a question that just came in. Are HSAs the same as FSAs? No, they are not. I probably need to do a separate video on those. You should not be using FSAs to save for retirement, because the money you put in to FSAs each year, you need to use by March of the following year. Right? HSAs allow you to save and accumulate money in them, where FSAs do not. So that's a great question. The tax benefits of FSAs are very similar to HSAs. You just can't use it as a long-term savings vehicle. Hopefully that makes sense. So anyway, that's step 2, right? Step 1, save for retirement in your 401k or similar plan through work. Step 2, if you are eligible for an HSA, put money into that account. From there, right, then that's when we need to bring the IRAs onto the table, traditional or Roth, depending on your circumstances. Few things to think through in terms of deciding which one. First and foremost, if you are covered by a 401k or similar plan through your work, you likely are not eligible to deduct your IRA contributions right now. The rules are a little bit more complicated than that. It is worth double checking. But if you're looking for a tax break right now, if you have a 401k or similar plan at work that you're not maxing out, your best bet is to increase your contributions there rather than use an IRA. But if you are eligible to deduct IRA contributions now, or you're self-employed or you work for an employer that doesn't have a retirement account, we need to decide, right? Do we deduct from our taxable income now and contribute to a traditional IRA, or do we put money into our retirement savings after taxes now so that we can then withdraw tax-free in a Roth IRA in retirement? And the decision there is actually relatively straightforward. You need to compare your tax rate now versus what you think your tax rate will be when you retire. That's how we make that decision for the most part. If your tax rate right now is much higher than you think it will be when you retire, particularly if you have a high income job now, taking the deduction, contributing to a traditional IRA, and then paying the taxes when you retire generally is a good strategy. On the other hand, if you think you're going to be having more taxable income in retirement via your distributions from your retirement accounts, then and therefore your tax rate will be higher then than it is now, you want to pay taxes when the tax rate is relatively low, right? So contribute to a Roth, and don't deduct money now, but then let that grow tax-free over the course of your life. Now, it is a little bit more complicated than that, in that you need to consider not just the tax rates now, but how they'll change over time, right? Just because your tax rate now might be higher than you think it will be when you retire, the unknown piece there is how the tax rates will change, what Congress will do to the level of taxes that they collect between now and when you retire. I'm personally of the belief that if you're in your 20s and 30s right now, it's very, very likely that taxes will be higher when you retire than they are now. Right now, particularly after the Tax Cuts and Jobs Act that was passed in late 2017, taxes are very, very close to all-time lows right now. I would expect that those will be higher several decades from now, admittedly, right? So they're as a result, I really do think that Roth IRAs are a very good deal for people in the early stages of their career. But there's like a few other things you need to think through when it comes to, again, that generally should be how you make this decision. There are a few things you might want to consider. First and foremost is that Roth IRAs are more flexible than traditional IRAs. The money you put into a Roth IRA, technically you can withdraw your contributions now without having to pay any taxes on them. If you were to have an emergency, if you decided you wanted to use your retirement savings to buy a house or something like that, I don't necessarily recommend taking money out of Roth IRAs, but if you were ever in a pinch, you have the ability to withdraw the money that you contribute without a penalty. Now, the investment earnings on the account are a different story. You can't withdraw those. But if you're concerned about flexibility or needing the retirement savings you're contributing early, a Roth might make more sense for you, even if the tax math now versus when you're retired doesn't quite work out in your favor. And then the final piece is the one other thing we haven't talked about when it comes to Roth IRAs yet, and that is that not everybody can contribute directly to a Roth IRA. There are income limits as far as once your income hits a certain level, you start to lose and eventually lose completely your ability to contribute to a Roth IRA. And you don't have that problem with a traditional IRA. When I put this up on our website a few days from now, I'll have the full tables for what the income limits are. Long story short, for the 2018 tax year, if you're single, once your income hits 122,000, you lose the ability to contribute to a Roth IRA. And if you're married, when your combined family income starts to exceed 193,000, you start to lose the ability to contribute. Again, it's a little bit complicated. We'll have the full tables up on the website shortly for both 2018 and 2019. But that is the other thing you need to think through as well, right? Is, are you even eligible to put money directly into a Roth in the first place? If you're not, we've talked about on this channel before how to do Roth conversions to essentially backdoor your way in to contributing to a Roth. That is a very complicated strategy. I don't recommend you do that without seeking professional help to do that. Just know that if you want to contribute to a Roth, but you're technically unable to because your income is too high, there are some workarounds that you could potentially explore. So with all that, right, that's our third option, right? Contributing to either a traditional IRA and deducting the contributions, or to a Roth IRA and would be able to withdraw the money tax-free. Next best option from there particularly applies if you aren't able to deduct your traditional IRA contributions. You can still contribute up to $5,500 a year, $6,000 a year starting in 2019. You can still contribute to the account, right? You can't deduct the money you're putting in. You'll still have to pay taxes when you take the money out. What's the benefit of doing that then? In between when you contribute now and then when you take the money out when you retire, you will not owe taxes on the investment income that's generated in your traditional IRA, even if you can't deduct the contributions now. At the very least, it's a way you can defer some of the dividend and capital gains taxes that you would potentially, or that you would accrue on investments that are held in just a generic investment account. So, again, even if you can't deduct your IRA contributions, it is worth still contributing as an option if you've already exhausted the options that we've gone through. And then finally, if you've exhausted all of those choices, the last thing you can do, put your money in just a generic brokerage investment account, right? There's no tax benefits for doing so, but at the very least, you're investing money so that it will hopefully grow so that it's worth more when you retire, even after accounting for inflation, than it is now. You need to be careful with the types of investments you put in just generic investment accounts, because you are going to owe dividend and capital gains taxes on those each and every year. In particular, you want to, I would steer away from actively managed mutual funds for the most part that tend to have a lot of turnover in them that generate the taxable income from them. I would steer much more heavily toward ETFs or even index funds, or maybe even individual stocks and bonds if you decide you want to go that route, because those tend to be much lower turnover unless you're actively managing them on your own, which means that that the tax drag, if you will, on your investment returns will be less if you go that route. So that, in a nutshell, is how I would recommend thinking through saving for retirement, right? Employer accounts, HSAs, traditional or Roth IRA, if you can deduct the traditional IRA contributions. Fourth choice is non-deductible IRA contributions. And then finally, just generic investment accounts. What I would steer away from as retirement savings vehicles, particularly if you're under the age of 50, any sort of annuity product or permanent life insurance product. We've talked at length about life insurance here before, and you know why I'm not a fan of that when it comes to saving for retirement. Annuity products work the same way. If you're under the age of 50 and somebody tries to pitch you an annuity project, you should run like hell, just simply put. I would not use those strategies for the vast majority of people. If you do think that either an annuity or a permanent life insurance policy for investing purposes is the right choice for you, I would not do that unless you get the opinion of a financial planner, financial advisor who does not sell those products and earns commissions on those products. There are a handful of circumstances where it could make sense. You want somebody who doesn't stand to gain from you buying one of those policies to tell you that it makes sense for you before you do that. But again, for the vast majority of cases, you want to steer clear from life insurance as an investment vehicle and or annuities. So in a nutshell, that's how I think through saving for retirement, right? The last part of Lynn's question was, how much we should be saving. Unfortunately, that is not an answer that I can give generically. In the example I like to give here, right, is, the reason why is that everybody has different visions for what they want their retirement to look like. You can think through a case of somebody who wants to buy a second home, a vacation home in retirement on the beach or in the mountains somewhere, versus somebody who wants to sell their home and buy the equivalent of an RV, whatever RVs look like in 2045 or so, right? Those different models where you're buying a second home versus selling the home you have generate very, very different levels of retirement savings needs. There's no one thing as retirement, even though we like to think about the lighthouses and the Adirondack chairs and all that other nonsense, right? It really does vary a lot from person to person, which is why a lot of these kind of savings targets that you see online about how much you need to have saved by age 30, 35, 40, by and large are not terrible goals to shoot for, but aren't something that makes sense to actually hold yourself accountable to. You really do need to think through what your situation is like, what your income, what your savings, what your expenses in retirement will look like to come up with a better answer for how much you actually should be saving for retirement. Hopefully today helped as a way to think through the mechanics of saving for retirement. If you want to talk about actual dollar amounts, I do offer free breakthrough calls where we can talk a little bit about that one-on-one based on getting to know a little bit more about you and your situation. Head to pacesetterplanning.com/contact if you're interested in setting up one of those free strategy calls. Again, Bill Nelson from Pacesetter Planning. Hopefully this was helpful as a way to think through some of the some of the different ways we should be thinking about saving for retirement. Thank you again to Lynn, we'll call her, for sending in the 3 great questions that we got. And like I said, we're going to be starting these videos up just about every week. Looking forward to it. Hope you can join us for the next one. Thanks so much.